Hi, it's Tuza here, back with another video, and I'll try and focus on this camera because I think it's the one that actually, focuses on me and not the screen because I'm focusing on the screen here. But yeah, back with another video. This one is entitled, let me just see, what am I going to title this one? But I'll write the title afterwards. But this one is basically supposed to be how I got into individual shares buying of companies. That is not active, share buying, but it is passive shares buying in companies. Basically, the story is very, very long, but I was interested in investing for quite a while. Very, very interested in investing and read a couple of books by, I tried reading books by Warren Buffett, but at that time, I didn't even understand what, all this compound interest and investing and whatnot was. So I read another book. It was by Rich Dad Poor Dad, Robert Kiyosaki. It was a guide to investing. That was like one of the first books that I, grasped and got my mind onto, with this whole investing thing and whatnot. And it gave me like the basics or the fundamentals of, or let me just say the idea behind investing. And anyway, to cut the story short with how I got into buying shares in companies and investing, basically, first of all, I would like to mention that buying shares, in as much as it seems to be a very nice thing and exciting and so on, sometimes it actually isn't, because the swings in the markets can be very drastic. And even as we go along, on this journey, as I'll be sharing some of the things and some of my experiences and what I'm actually going through at the time, you see maybe what I mean by, the swings, the upswings, the downswings can be drastic. And as they say, you can be taken out. Warren Buffett says, when the tides go out, then you can see who's actually skinny dipping. I might have even mentioned it in a previous video. But anyway, why I started with individual shares instead of, well, there's a lot of noise this side, but yeah. Why I started with individual shares instead of going into things like unit trusts, ETFs, and funds that are very, very diversified in the beginning, is because I wanted to understand what it is that these funds and these unit trusts were built of. The thing about maybe personally me is I am not comfortable with just giving, let's just say, money to someone, or giving resources to someone, or giving a task to someone and expecting them to do that thing for you, yet you don't understand what is involved in doing that particular thing. It's like telling a builder, like, hey, look, go and build that side and I'll find you. Go and build my house and I'll find you after you finished building. Whereas you don't even understand what the price of the bricks are. You don't know what the price of the cement is, the price of the steel is, that sort of thing. Then you find that maybe that builder did not build as efficiently as they should have. So who's there to blame? Then you start, hey, no, you spent my money and you wasted money, or so on and so forth. So basically, for me, I wanted to understand the underlying bricks, the building bricks of what the unit trusts are, the building bricks of what these funds are, so that even when I eventually in life get into those things such as your unit trusts and your funds, when I get a report of what's going on in the fund, it won't be like, hey, what's going on in the fund? Like there's a negative, balance, or what's happening with the profits and whatnot and so on. You're surprised because you don't know what's going on. And now you've got someone who has to explain to you that, okay, we've had a bad month or we've had a bad year and this is what happened in the fund and whatnot and so on. But going into individual shares allowed me to sort of learn what the market is about, so I can understand, what affects the market. I know when markets are going through terrible times because I can see what is affecting those markets individually on a share point of view, and also on a larger point of view when you look at the whole entire market. So you can have like one share underperforming because its profits that the profits that were predicted actually fell short. So it's underperforming because its investors have lost confidence in that share, so the share drops. Then you can get some certain influences, such as we had COVID-19, for instance. COVID-19 caused people to panic and people to sell their shares, I don't know if retirement funds, but funds and unit trusts and so on. And so that whole pandemic caused the whole market to sort of tank, drop by I don't know how many points, but that sort of thing, that you've got a global crisis that affects the market. Even 9/11, I've heard about. I wasn't aware at that time, or I wasn't really bothered about what was going on in the world at that time. I was too young and I was enjoying my life. But that time when that sort of thing happened, there was a crisis and the market dropped. The whole share market dropped. So that sort of thing is, I started in individual shares so that I can get the understanding of what drives these markets, so I can understand the nuts and the bolts behind stock markets, financial markets, and everything that's affecting those sorts of movements from a macroeconomic point of view. That is, a much more global and broader economic point of view. But from that sort of experience, I also learned something, and which is, one thing that I can advise for people that are actually starting off in share buying and starting off in investing, and it's your first time, doing that passive investment kind of strategy. One thing that I learned is that when you actually start off with individual shares, when you start off, if you're like me, you don't really have a lot of resources in the world that you can actually throw at these shares and so on. And the other thing is, you don't have a lot of education, you do not have a lot of experience when you start to throw your resources at these things. So when you start off, the very safest way that you can go about it, I'm not a financial advisor, I'm just throwing out my experience and opinion. What I should have done earlier is that I realized that I needed more diversity in my own portfolio, because, like I said, the swings in the markets, if you only have a few shares that you own, because you can only own so many shares because you don't have enough resources, when those swings happen in the market, it really, really drastically affects your portfolio. But what happens when you've got diversity in your portfolio is that it balances itself out. So you've got maybe one share that's not doing well, you've got another share that's actually doing well. So it sort of evens out your losses or your gains. But if you only have like a few shares in your portfolio and one tanks, and you've got like a portion or a big portion of your resources or investments in that share, then when that thing tanks, you are gone down. You'll be in the negatives. Like, I can give an example with a company called Naspers. Maybe if you've heard about it, or some people have heard about it. Naspers, I hope I'm pronouncing it correctly, but that company owns DSTV, Take a Lot. It owns Mr. D Foods and owns, I think, OLX. It owns a couple of companies. I think it's got ownership in Tencent, which is in China. Now, what happened with that company last year is that in China, where they are, they've been having issues with the Chinese government and them having a stronghold on all these big tech companies. So that sort of issue that's been going on has caused that particular share to drop, together with all tech companies that are related to China or situated in China. In China, all those shares have taken a knock because of what's going on with China and tech companies and so on. Now, Naspers dropped to almost negative 26%, and it had stayed, I don't know if it's still down there because I jumped out, but it had stayed at that sort of value, negative 26% from the time that I bought in. It stayed there for over a year, maybe even till now, who knows, but it stayed there for over a year. Now, if I've got all my bets or all my resources on Naspers, and it's dropped negative 26%, and you're waiting for it to pick up in a year. It's a very difficult thing, which they also say, you need to be in it for the long term. Minimum 3 years, maximum, or let me just say minimum 3 to 5 years. Maximum is however long you choose to remain in, but the swings in a short term can be very drastic, and that is why I am saying that when you start off, it is safer to actually start off with unit trusts and your ETFs and indexes and so on and so forth, because they give you a lot of diversity. So if you've only got little resources, you don't want to lose those resources. So you put them in a more diverse portfolio so that your swings won't be that drastic. They'll be evened out, like I mentioned earlier. Anyway, like I was saying, the point of the video was to say that at the same time, personally, I got into individual shares first, because that gave me an understanding of how to pick these companies, how to look at the stock market, how to look at the financial market as a whole, from an individual stock level, and also from a very bigger and broad level, as in the whole financial market, so that I can understand, even when I'm in a portfolio like an index fund or an ETF, or I'm in a unit trust, I can understand why that unit trust or index fund has underperformed, or why it's overperformed or performed very well. So it gives me an understanding of what's really going on in the financial market. And that is why I started from individual shares and stocks and so on. But it is important to do your research before you jump into any one of these things, because you don't want to own something that you don't understand. I think Robert Kiyosaki says in his book, even as I end this thing, he mentions some of the risks of an investor. And one of the risks that he mentions is the investor himself. You yourself can be a risk to your investment. And how this happens is when you yourself, first of all, you don't understand what you are investing in, you don't have the knowledge, or you have not spent time to acquire the knowledge behind what it is that you are investing in. And the other thing is your own emotional stability, because of course there's a lot of excitement and there's a lot of panic that goes on in the stock market. Crypto is going up and everyone buys in, crypto is going down and everyone sells. So you've got to be in charge, and you've got to be in control of your own emotions. Despite the swings, the upswings and the downswings, you've got to understand what it is that you own, and stay in there for the long term. Anyway, I'm not a registered financial advisor. This is just me giving opinions and sharing my journey. So feel free to like and subscribe if this information is useful to you. And from here on, cheers.